Fantastic. Hello, everyone. My name is Reed Glockner. I'm going to be telling you guys a little bit about what we've got going on over at Critical Perception over the past decade here. So moving in, we're going to take a broad stroke look at everything we've been doing for the past 10 years. So right out the gate, we lost our Corporate Social Responsibility Award to Dino Cams and Drones, unfortunately, last year. But we've been in tight competition with all the other companies in the industry for the past 5 years. With that being said, we have netted 4 of the past 8 years, with being second place for all other 4 years. We're going to take a look at our net revenues over the past 10 years here. You'll see that right up top in big font there. You'll see that we have tripled our net revenues over the past 10 years, putting our return on equity stabilizing at about 50% over the past 2 years. We saw a high spike in year 12, which we'll go over here briefly, as well as a low point in year 10, where we made a couple of bad decisions, but we'll go over that in depth here in just a moment. Moving on, you're going to see a quick look at our stock price up top. Again, we've done fantastic things over the past 10 years. We are almost to $400 for our stock price, sitting at about $390 with a fantastic credit rating. Again, we've got a little bit of things that happened at year 12 to talk about, but we'll go a little in depth here in just a moment. You'll see our image rating has been very important to us since the beginning of our takeover and turn into Critical Perception here with our rebranding. That was one of the first things we focused on, because in this day and age, building a sustainable company is key. If we're not sustainable within the next 10 years, we will crumple out, and that will be the last you see of Critical Perception. We won't be thinking very critically at that point. But again, let's get into our year 12 turning point here. So I said a couple of things happened here. I've got them noted down here at the bottom. We'll go over them briefly here. Our AC camera expanded the model count. With that being said, we were not as prepared for that model expansion as we needed to be. We didn't price accordingly, and we suffered for it. But we turned that around and used it to our advantage when we expanded our drone segment in year 13, which gave us a great spike as well there. Along with that, it marked that shift into our drone market development with that next model. And we decreased our marketing expenses across the board, being able to capitalize on that image that we had already built. We turned down that expense for our marketing, let DynoCam take over as the lead marketing expense there. Then we used a 1-year loan to clear our debt, which again is why we saw such a hike in our credit rating there. We went from doing 5-year and 10-year loan investments to that 1 year to take out all of our debt in 1 year, which left us with about, I think it was about $67,000 to play around with when the next year ended. But with that 1-year loan, we were able to clear that debt, see our credit rating jump through the roof, and then we were in the black from there with our sales. From there, we're going to talk a little bit about our vision statement. Our goal, again, right out the gate, was to create a sustainably sourced drone that's durable enough to last any job site, with battery life enough to endure extensive flight times. And we're looking into a future in solar power. With all of the advancements in childcare learning, we're looking at building a STEM model to help out with STEM learning, so kids will be able to actually build their own drone and code it with common technologies like Python and JavaScript for coding language. Looking next at some of our performance targets, we're going to look at our earnings per share. Again, we're going to see gigantic leaps over the past 10 years. We're starting to stabilize. We've turned down some R&D in our drones and AC camera departments in order to look into some more R&D research into our STEM models and solar panel models. So we're going to talk about how that affects our production companies here in a little bit as well. But over the next 2 years, you're going to see a growth of about $5 in our earnings per share for our projections here, giving us about $2.50 per year to meet those standards. With our return on equity, we're trying to decrease our expenditures across the board. With that, we have toned down a little bit of our base wages. No, I take that back. We did research on toning down base wages for our production facilities. We actually found that we were going to spend less per item produced by giving a raise to our production facilities, which we'll go over those numbers here shortly. But with these changes in mind, we're looking at an increase on return on equity as we have bought back all outstanding stock and retired all outstanding stock available. We believe this to be a realistic goal. Looking again at our credit rating, we're going to see a slight drop over the next 2 years, sheerly because we might not take any loans out. We might just sit stagnant with our 20 to 80 debt equity ratio just to be safe. We're stabilized and comfortable, and we're not sure if we're gonna which direction we're gonna take for our next R&D feature. So until we have that decided over the next 2 years, I think that credit rating is going to stabilize unless we decide to invest in more R&D and take out a loan in year 17, which again will cause our credit rating to drop slightly. Looking at the next couple of years as well, we lost out on our corporate social responsibility award in year 15. With that in mind, we want to get our image rating back up. So with the next 2 years, we're going to increase our overall donations per item sold in the hopes of raising our image rating within the next 2 years to 94, giving us a 2-point raise each year. Moving on from there, we're going to look at our stock price. As we have stabilized and we look to trim our business down, trim expenses out, and look to raise our profit margin, we should see a rise in stock price. With the past 10 years of market research, we should be able to raise our prices accordingly with just a slight tweak in the product model over the next 2 years and maintain our revenues and increase our profit margin off of them. With that, we should see a rise in stock price, and we do not plan to retire any more or sell any more outstanding stock in order to raise funds. At this point, with our market research, we should be able to raise about $1.2 billion if we sell 5,000 stock right out the gate, which would also lower our stock price to about $200 a stock. But if we need the funds, we're able to go down that route. Next, we're going to go over just a brief overview of our action camera strategy in the Western Hemisphere. So this was going to be our, I want to see most competitive field of market here between the two Americas. So right out the gate, you're going to see our price jump in year 10 if you look closely here, and I actually have the ability to pull a lovely laser pointer out here. So we're going to take advantage of that, guys. So as you can see, we jumped from $283 to $333 in year 10 and $275 to $300 in year 10 here. Now that may not seem too very extreme in comparison to how our other friends jumped there, but for our best cost strategy, it was extreme for us, and it was extreme enough for us to lose out on some serious market share, as well as we jumped from 23.6 to 22% market shares there right out of the gate, and a little more extreme from our year 8 to year 9 was our drop off there. But again, we saw a rather extensive drop off from year 8 and year 9 sales across the board for the Western Hemisphere. Now, one of the main things that we focused right out of the gate for our AC camera sales was pumping out large numbers in order to accommodate our special contract sales in year 9. We did our very best to increase our production facilities in AC camera industry very quickly. As you can see, we got capped out in year 8, and we didn't produce enough because of the fact that we didn't jump our sales prices like everybody else did, and everybody really wanted our cheap cameras. Now that did fantastic things for our brand reputation, but it hurt our wallet. So with that in mind, we got a little greedy and jumped year 10. As you can see, it did not do well in North America. It did not do well year 11 in Latin America. with that in mind, we did make a little bit of change and go back to our best cost strategy, as that is one of the big lessons that we learned, is not to jump too far, too fast. But we will move on to the Eastern Hemisphere, where again, you're going to see some of the same things reflected here. We lost out on sales year 8. Across the board, just about everywhere except for North America, due to that lovely underjump in price. Oh, beautiful. Get rid of all of my lines. Excuse me as I learn Zoom as we go, but I digress. We had a very global strategy across the board for our AC cameras, which, as of the exception of year 8 and year 9, was a best cost strategy, the exception of our very greedy 2 to 3 years where we tried to change that and found out that did not work for our brand. But again, a very global cost structure where you'll see by year 15 across the globe, we had evened out to about $350 per sale price per unit. Then our PQ at about 7.1, which put us about average with our competition there, but we'll go over some competitive numbers here in a moment as well. Then we will move on to those competitive numbers we mentioned. We're going to focus on North America for all of our competitive numbers, just because that was the most competitive area there next to Latin America with the currency exchange rate that we had going on. This kind of found the most competitive markets to dabble in. But down at the bottom, you're going to see our regional averages there, which is going to be, of course, everyone's average. And up at the top, you're going to see our numbers over at critical perception. Right out the gate, we're going to look at our prices across the board, which, relatively speaking, year 5, everybody started out the same. Industry was very standardized. Year 6, we saw jumps slightly above average in our price, but our PQ rating was slightly above average as well. So we saw just a slight gain in our market shares compared to average. Well, we learned from this. Year 7, we jumped just a little bit less than everybody else. And it worked out great for us as we saw market shares jump above average, and we continued this trend to the point that we lost out on sales across the board because we didn't stock enough for how cheap our cameras were. Moving forward, we thought to learn from this and expand our price average, our average price across the board for the next 2 years. As you can see, it worked great in North America for the first year. We went over our other numbers. It didn't work out so great for the other areas of operation for those years. So with that being said, we went back to our standard best cost strategy to offer the best quality camera we could for the lowest price. With that blunder of a price in year 9 or year 8 to year 9 that we felt we lost a lot of profits on, it worked to our advantage with that brand reputation that we mentioned before. And we leaned on that in year 12 and year 13 as we started to cut all of our advertising budget in half across the board for all of our global expenditures. Now, this definitely changed the advertising market, as we had already built enough brand recognition that we were almost the GoPros of this competitive simulation here. Everybody knew our name. We were in every single market, almost like the disposable camera for a little bit there. So everywhere you looked, you saw our brand name. We could afford to stop paying so much for advertising. We were already on the shelves. Everybody already knew our product. So we did. And we're going to continue to lean on that just a little bit. But we'll go over our overall competitive efforts strategy for the next 2 years a little more in depth as we look at a side-by-side comparison between ourselves, Company B, and Company D here towards the end of our presentation. Now, moving on, we're going to get into our UAV drones. If I can put my lovely spotlight away and move on to our UAV drones in the Western Hemisphere here. Again, we're going to see our North American and Latin American numbers side by side here, as they were more of our competitive side of the field of operations here. You're going to see our price point never made it past $2,000, as that was kind of one of our goals, to make the most competitively available drone on the market. We wanted to take advantage of the best cost structure to the best of our ability across the board here, because it worked well for our brand. As you can see, we maintained above market share averages across the board here, as between our companies, each one of us were entitled to about 16.5% for a average breakdown there. We did not see drops below 18% other than year 6, as we were testing the waters there with our drones in the first market area there. But with that being said, you saw a shift in year 12 as our drones became more profitable than our AC cameras. That was partly due to the fact that we jumped the prices in year 10 and suffered our market share across the board because of it. But it could also be due to the fact that we overhauled our production facilities and started using our robotics facilities in year 12. Might have had a huge impact on our cost profit structure as well there, that I didn't think about when I was putting these slides together until just now, but that's a fantastic thought there. We're gonna move on real quick to our Eastern Hemisphere here. You're gonna see our Asia Pacific numbers and our Europe Africa numbers accordingly there for us. Now, we made great strides in Asia Pacific in year 9 and year 8, as we had that very low cost structure, and we jumped our PQ ratings accordingly as well. We saw huge focus shifts in our R&D facilities from AC cameras to UAV drones that year, and our PQ rating jumped about 1.4 accordingly. Now, that was the same year that we had our very cheap camera sale, which jumped our overall brand reputation greatly to that 97 of 100, which again went hand in hand with our being able to drop all of our advertising cost to the end of the year there. Now we're going to move along to our regional average comparison of the North America here. You will see our overall cost structure kind of stabilized. After year 11, we hit that $2,000 point. We started trimming our side of things, and we started becoming more and more profitable, and we let our customers win off of that profitability as well. So not only were we making more money, but they were saving more money by buying our drones accordingly. So year 12, we dropped our price $51. It was a very obscure $51. That way we weren't a very round number, and we could slide right in there underneath any round numbers that slid in there as well. And we kind of kept that across the board starting year 10 as well. We noticed everybody was playing around with very nice, neat round numbers. And why not slide in there underpriced by $1 or $2 or $3 if we can? We'll catch the eye for the customer there. So moving along, we're going to look at those production and facility changes. So right out the gate, we've got 2 of the same charts here. Up top, those are our current numbers. Down below, we looked at some slight changes to see how things would change if we changed the base wage for our PAT members in our AC camera facility by -5%. Now, mind you, our AC camera facility is one of the highest paid facilities in the industry. Now it comes in about $15,000 a year for their base average wages, more than the regional average. So with that in mind, we figured it wouldn't be out of this realm to decrease their wages a little bit as we look to expand elsewhere. And that will give us the ability to maybe promote within to stipend out any grievings or misfeelings that happen from reducing those wages as we look to expand elsewhere. So we'll be able to hire or promote from within to compensate for that base wage. But with that in mind, after we looked at these numbers, we actually find that we will be paying more for our overall, excuse me with my lack of ability to use this lovely software here. All right, with our overall unit price jumps by $1.14 by reducing their overall rate. So their productivity drops enough that it doesn't make sense to stop paying them the amount that they do. So we're just going to go ahead and look in the opposite direction with that in mind and look for the opposite effect accordingly. Ooh. Now, like I said, we're relatively higher than the rest of the industry average here. Granted, my 15 is a little off there. We actually come in about 11 more than the industry average if we stabilize at 0% change here. Now, with that in mind, again, we must look at our total compensation as well, because that's where that 15 comes from. Our fringe benefits, our attendance bonus, and our assembly quality incentive all do fantastic things, not only for production and productivity in our facilities, but it also gave us the warranty rate that we were able to capitalize later on as well, as we were able to provide a year-round to 180-day warranty for each drone that we produced on the UAV drone side of things as well. Because of those numbers, those bumped up our overall quality value. So each one of our drones that were on the market were able to stay on the market for longer, and the ones that sent back for our warranty repairs were not nearly as high as the rest of the industry there. So we were able to capitalize on that, and we had a little bit of a differential advantage because of that as well. So moving on from there, we're going to go ahead and talk about that perhaps we need to pay more for our UAV drone workforce, because reflective of our AC workforce, AC camera workforce there, we are above industry average, but industry average for the UAV drone workforce is slightly higher. So if we are to maintain a equal cost structure, equal benefits compensation structure in comparison to the industry average for both industries here, we need to look at raising our base wages, as our assembly quality incentives, attendance bonus, and fringe benefits package are all already pretty maxed out. We can't give them any more there. We're going to go ahead and look at a 10% increase in wages. And we're going to actually look at all of our labor cost drop off significantly down there, which will enforce our theory that this might be the right move to increase our base wages here, as our total per unit for AC camera will actually change as well, looking at 37.16, and our UAV drone workforce compensation looking at 75.48 per unit now. Now, moving along, we're going to take a look at our financial strategy over the past 10 years. So with this, we're going to look a lot at our overall credit rating to loan structure, as we did things much different from our number one competitive dyno company over there. We could never quite figure out what they had going on with their 19 to or 80 to 19 debt equity ratio structure. It was very risky and hard for us to establish a baseline. So we kind of watched them play around with the market very differently than us the whole entire time, and are very curious about their strategy. But I digress. Enough about Dyno Company. Let's talk critical. Right out the gate, we started out with a loan of $60,000. Moved on to year 4. We picked up another loan of $20,000 with a second loan of $80,000 for some reason. We split that. Now, year 7, things got a little higher price ranged for us. We started accruing more debt. Now, each year, we took a loan out here to cover our original principal from the last loan, as well as some outstanding debt or outstanding stock repurchases, as we were trying our best to retire stock each year available to the highest amount possible. As you can see by the end of the simulation, we made it to the minimum stock outstanding numbers of, I believe it was 15 million after those extra zeros tossed on there. But I digress. We were buying stock back as fast as possible and taking out loans as fast as possible to cover them as well. So you'll see our total loan price jumped to about 200 million by the end there, as that was our total debt accumulation before we were able to take a 1-year loan out in year 12, as well as a nice $10 million loan out in year 12 for our 5-year loan, as you could only take out 200 million for a 1-year loan at that point in time for our company. That's all we were able to do. So we had to split it into 2 loans there for us, but it worked nicely as it helped stipend off the total credit rating hit we took that year. But again, we took a gigantic credit rating hit as we took a $200 million loan in year 12. So that's only to be expected, as we accrued a large amount of debt and then paid it off the very next year to see it jump right back up to an A credit rating. So just a quick broad stroking of why year 12 to year 13 is so very drastic. Moving on there, we will look at why we retired stock, each year. You'll notice our company was one of the few companies that got by without ever paying out a dividend. Now, we were able to do this because buying and selling our stock became profitable enough for our stockholders to not need us to. Our average return on equity was high enough throughout the years, and our stock price continued to grow throughout the years, which met investor expectations, and therefore we never saw a reason to take internal money and turn it external to stockholders. From there, we were able to continue to invest from within, keep a nice debt equity ratio, and build relatively risk-free. Now, we're going to take a quick look at our competitive analysis over the last year 15 here. Now, on the left there, you're going to see one of our lovely charts that you're already familiar with, but in case anybody made it through this simulation without ever seeing one of these guys, this is a fantastic chart. It shows on the bottom x-axis your sales, promotions, and advertising on a low to high spectrum, and on the left axis, or the y-axis, you're going to see our price and PQ rating on a low end to high end spectrum. So you'll be able to see your overall product quality to your advertising and promotion rate. Now, the actual size of your circle here is going to be directly representative of your market share. So you'll see right out the gate, company B, C, and D were in tight standings. But I mentioned we killed off all of our marketing expenditures and advertising expenditures. We halved them. So that took our C and took it from being right there next to D and slid it over there on the far left side of B. Now, that's great for me because my circle is still really big, but I'm not paying for all of that advertising. That is all of my brand recognition coming into play here, which is absolutely beautiful. Now, in the coming years, as you can see, Dino Company has come out of the water from their very interesting debt equity ratio situation where I thought they were going to go under and bankrupt, but I digress. They came out of it, their risk played out, and they ended up taking over and being the #1 in the industry for year 15. So kudos to them. But year 16, our best goal is to take directly from them for their market shares. So with that in mind, we're going to go for that cash grab, what I like to call the Snapchat advertising route. We're going to pay out a whole lot into our advertising bracket again and see what happens with taking market shares directly from the people that buy based off of advertising. Because as you can see, that's where Dino Company enlarged their circle. But moving on there, again, our current leading competition is going to be Beam Carpentry and DynoCam and drones. And the next 2 years will be directly related to building a better differentiation a better differentiation strategy by creating our next competitive weapon, which again, we're going to go back to our vision statement. We want to see about expanding our drone models to include a solar powered drone and or a STEM learning drone and AC camera models. Because with STEM learning, not only can they build a drone, but we can make a AC camera model that works with our drone as a independent piece that we can sell as an AC camera product as well. So why not expand our drone in 2 different directions with our AC camera models? But let's talk a little bit about what we did wrong. Because this was a fantastic simulation and I absolutely did something wrong. But no, I am relatively proud of my fake company over here. We did just price rise in year 10 was way too aggressive for our UAV drones. As you can see, whoop, we'll break my PowerPoint real quick. But as you can see here, in year 10, we saw the first dip in revenues to being below AC cameras. And that went right there next to our AV price jump. That was absolutely stupendous in comparison to every other price jump for every other industry before that happened. Now, might seem a lot more, let's see, drastic on the price jump over here, comparatively speaking to the revenues here. But we also have to think about, this is $500 million, $500,000 in revenue. 500,000, 500 million. I can't recall with all of the fun rounding that we've done this simulation. Again, one of these things that I have very well done wrong. All of our revenues here are rounded off by 3 zeros, as I fixed in my year 10 recap, but not on my what we did wrong here chart, but I digress. So again, that's a huge profit area. So of course, it moderating out here and dropping a little bit here is actually reflective of a there was a huge difference. As my friend here just let me know, my audio went down, but yes, we'll back it up just a little bit. Reflective of that year 10 price drop, we're going to take a look at our stock price and return on equity here, because as it did not highlight it very well just by looking at the revenues here, you're going to see our stock price not only ceased to increase, but it also dropped significantly year 10, as well as our return on equities dropped significantly as well by about 13-14% there, which was not good for our investor expectations. I believe that was the only year that I didn't get points for making investor expectations, but I digress. That was my biggest blunder of the year right there. And aside from that, I believe that's all that I have for you guys. But I hope you enjoyed my very well put together presentation and appreciate you taking the time to watch.